Today, financial repression is the real story. Hello again, it's Martin North from Digital Finance Analytics. Well, notice posts covering finance and prop news with a distinctively Australian flavour. It's clear that together the Reserve Bank and the government are executing a repression strategy where interest rates are artificially kept lower than inflation. The net effect, as we've seen, is to drive wealth transfer from savers who see their capital eroding in real terms whilst receiving a pittance in interest, if at all, to borrowers who are still being encouraged to borrow and to borrow yet more. They appear to hope this approach will address the low growth, high debt spiral. It probably won't. And at what cost? And I want to make the point that the Council of Financial Regulators, which includes the Reserve Bank, Treasury and two regulators, APRA and ASIC, are clearly on the same hymn sheet. So in no way is the Reserve Bank independent of government. They're all in the same foolish boat, driven by a leaking set of economic theories. High debt has consequences, of course. As Steve Keen said in my live show last night, private debt is the real problem. It's higher than it's ever been by policy choice. And the latest results from CBA today revealed above system loan volume growth, but significant margin compression. And consumer arrears were low in the quarter, with home loan arrears at 58 basis points of gross loans, down from 64 basis points at June. But the new temporary loan repayment deferral arrangements currently represent around 1% of total home loan portfolios, some of which are likely to convert into arrears as the New South Wales and Victoria economies reopen. And troublesome and impaired assets were $7.1 billion at September, down from $7.5 billion in June. So the environment is sticky for the banks and costs of funds are rising, so they will either lift mortgage rates again or have to eat the difference. And my own surveys reveal very high levels of financial flow stress among mortgage holders, even at these low interest rates, still significantly higher than pre-COVID levels. And yet, according to the Reserve Bank, the majority of mortgage holders are already maintaining higher loan repayments than required and won't be shaken by a climbing cash rate. And this is according to Lucy Ellis, the Reserve Bank Assistant Governor, who appeared before the House of Representatives Standing Committee on Tax and Revenue last Monday for its ongoing inquiry into housing affordability. Reflecting on the serviceability of mortgages, the economist told the Parliamentary Committee that she observed the majority of borrowers were paying off more of their home loans than required by their contracts, particularly during COVID. Now people have been socking away money in offset accounts and redraw accounts during this period, and particularly where you had lockdowns, some people were not spending as much as they ordinarily would, Dr. Ellis explained. And she made the comments, as economists have speculated a cash rate movement from the current historic low of 0.1% is on the cards. Some have tipped an increase as soon as November next year. And recent survey data from the Finance Brokers Association of Australia found that 3/4 of borrowers and renters believe that rising interest rates would place pressure on their financial position. Around 57% of the survey participants said that if rates were to increase, they would need to consider refinancing their mortgage. But Dr. Ellis believes differently. One important context here is if and when rates do eventually rise, a lot of people will not actually need to raise their actual repayments because they're already paying more than they need to, according to their loan contract, she told the committee. Last week, the Reserve Bank released research about liquidity, tying a rise in household liquidity in recent decades to rocketing house prices. While aspiring buyers needed to accumulate greater levels of cash while saving for a deposit, those who already had a mortgage have been incentivized by the threat of future shocks to make higher repayments than needed and to build up greater cash buffers. Offset accounts were also found to be a primary driver of raised cash buffers with mortgage debt, at least since the 2010s, with the RBA noting borrowers using the product tended to have larger buffers on average and also experienced a greater rise in buffers over time. Mortgages with offset accounts currently comprise around 40% of home loans in Australia, they said, while mortgages with redraw facilities make up around 70%. And Dr. Ellis called the widespread use of offset and redraw accounts one of the most desirable features of the Australian institutional framework. Other countries do not have the widespread use of offset and redraw accounts, which are the most tax-effective form of precautionary saving ever invented, she commented. And Dr. Ellis noted that setting the interest rate at low levels had pushed up housing prices by allowing consumers to service a larger mortgage on the same income, but the alternative wasn't desirable for the central bank. The response I would have is that the alternative is being a high inflation country, much higher inflation than our peers, she said. And while that would involve difficulties attracting capital, it would also involve economic instability, and there's swings and roundabouts. And Dr. Ellis also reflected on the burden of a mortgage under different settings. If you conceptualise, you buy a home, you live in it, you pay off your mortgage. In a high interest rate world, you end up paying more interest overall, but your income probably rose more quickly, and so those repayments declined more quickly. You inflated your debt away more quickly, she said. In a low inflation world, you end up paying less interest overall cumulatively, but the burden of that repayment doesn't inflate away quite as quickly when you've got lower nominal income growth. But of course, the average loan is much larger, so people are more exposed to even small rate rises. And yesterday, the RBA's minutes of the November board added a little new insight only from earlier statements, but we did learn that the board plans to inquire into the yield curve target policy that was introduced in March 2020 and cancelled following the November board meeting. And later in the day, the governor expanded on those intentions to cover all the extraordinary measures, yield curve control, quantitative easing, and the term funding facility, and forward guidance that were introduced during the COVID-related emergencies. Now, of course, this is an attempt to head off the calls for a more complete review of the role of the RBA. That's the real inquiry we need, not just to look at some of their policies. So this is further misdirection from the RBA, trying to avoid real accountability for many years of bad policy decisions, in my view. In Lowe's subsequent speech, he also discussed the dynamics of the recent surge in inflation overseas in terms of the rebalancing of spending between goods and services. In the G7, goods consumption lifted by 10% since 2019, whereas services spending was down by around 7%. Supply of goods has been constrained by lockdowns. Demand was boosted by fiscal payments, while the pressure on logistics from the demand surge boosted freight and other transport costs. And he noted that central banks and international agencies expected that those inflation pressures would subside in 2022 as supply disruptions eased and spending rebalanced away from goods to services. And he noted that the IMF was forecasting a return to around 2% inflation in the G7 in 2022. But the key issue is how labour markets respond to the current surge in prices. It would be unuseful, he said, if prices and wages were not moving together. In particular, the risks were around higher prices boosting inflationary expectations and wage norms. A period of higher wages growth would have a persistent effect on overall inflation. And a significant issue here was going to be the balance between demand and supply of labour. This is seen to represent a major difference between the US, the UK, New Zealand and Australia, as well as Asia and Europe. Policies in Asia and Japan to allow workers to remain attached to their employers during COVID have ensured that participation in employment, they said, are sustainable when compared with the US, where the participation rate has remained stubbornly low. A more flexible labour supply can contain wage pressure when the demand for labour rises as economies reopen. A further test is the strong demand for services as economies reopen. And he argued that we are already seeing this dynamic play out as wages growth is surging in the US and the UK, while it's been contained in Australia and Japan. And turning direct to Australia, he played down the recent surprise lift in underlying inflation as it, quote, remains lower than the average of the past 3 decades. And he noted the supply-demand imbalance showing in the cost of building materials, the supply shock effect on some imported durables, although there are some important differences compared with the UK, the US or Europe. The cost of electricity has been falling in Australia with the surge in renewables, while overseas power systems struggle to meet demand. But he put considerable weight on the inertia of Australia's wage-setting system, annual minimum wage agreements, 2 to 3 year enterprise agreements, and public wage policies that move slowly. Of course, that inertia is not prevalent in the informal bargaining sector, while the possibility of industrial action as workers feel threatened by rising costs of living in the face of labour shortages could threaten the inertia theory. A potential change of government by May might also have implications for the minimum wage resetting result. This leads to the key foundation for the governor's confidence that market pricing for multiple rate hikes in 2022 will prove misplaced. We're expecting a gradual pickup in wages growth as the labour market tightens. And more importantly, he said, we are using wages growth as one of the guideposts in assessing progress towards our goal and whether inflation is substantially in the target zone. Now, of course, one nagging uncertainty that he often refers to is the link between the forecast unemployment rate of 4.25% by the end of 2022 and wages, since we have not seen such a low employment rate since before the GFC and a 4% unemployment rate since the 1970s. How wages growth responds to such labour market tightness is a key issue for uncertainty of policy, and he ended his speech with a similar message to those in the minutes. It's likely to take time to meet the conditions we have set for an increase in the cash rate, and the board is prepared to be patient. And in the subsequent Q&A session, Lowe, when asked about the mismatch between his guidance and market pricing, pointed to a different reaction function between the market and the RBA. The RBA does not target house prices. The pace of inflation pickup required by the market to justify hikes by mid-year would require wages growth to quickly lift to above 3%. And given his views on the inertia of wages growth, that seems very unlikely. And he was more balanced in the issues of the level of spare capacity in the labour market, pointing to high underemployment and the possibility of a significant lift in supply as international borders reopen, relieving skills shortages as well as relief for hospitality and agriculture with foreign students and backpackers returning, meaning there will be less chance of wages growth. And when asked how he would react to a 3% plus underlying inflation but a 2 to 2.5% on wages growth, implying negative productivity growth, he argued that such a configuration would question the sustainability of the lift in inflation and would be inclined to look through the high inflation print. This point emphasised the importance of the wages picture as the measure of sustainability, and arguably the risk in relying on the wage price index with its inbuilt inertia is that it's sending a misleading signal about the likely build-up in wage pressure. Most likely, in reassessing the quality of the wage price index signal, the RBA should be weighing up some other aspects of the labour market, just as the FOMC uses a number of measures for maximum employment. In the body of the speech, the governor did point out that the market's expected peaks in the policy rates will be much lower than in previous cycles, so it was with great interest that he speculated that the Australian peak might be around 3.5%, a positive 1% real neutral rate, and he noted the zero productivity growth implication behind a peak of 2.5% is zero. He argued that he expected that savers would not be satisfied with another era of negative real rates, but overlooked the implications of positive real rates for highly leveraged asset markets and the feedback effects of sharp falls in those markets on the economy. And he teased the audience with a commentary on the trajectory of inflation and wages. The policy response to a sharp trajectory would be different to a slow grind, presumably for the same absolute level of inflation and wages growth. For the market, which is expecting the first move around mid-year, December and March quarter wage price index prints will need to show that rapid upswing in the trajectory. And bear in mind, the nation and businesses will be in tight election mode. Businesses are not known for bold decisions like changing the approach to wage settings when faced with uncertainties around elections. He noted the key criteria for the decision at the February board on the bond buying program, because last week there was a forecast from Westpac that the program will be cut from $4 billion to $2 billion per week, with the program to expire at the May board, while confirming that the actions of other central banks and the smooth functioning of the bond market would be considerations for the decision. He emphasised that the bank's forecast would be as important as the actual data, with the forecast unlikely to change significantly to drop the program altogether. I'm pretty sure that Westpac's on the money here. And he clarified the use of market pricing, by the way, for the interest rate profile used for the forecast that were released for the November Statement on Monetary Policy. While the bank had a very different view to market pricing, he argued that due to the lags in monetary policy, the impact on the forecast would not be significant until 24-25 beyond the 2-year forecasting horizon. And since the RBA adopted the policy of not acting until the conditions were actually achieved rather than being preemptive, we've not heard much about lags in policy. This just emphasises the importance of the trajectory. Achieving the objectives with a steep trajectory would trigger a very different response than a more gradual trajectory. And finally, the governor argued that market stability had returned after the abandonment of yield curve control as measured by the bid-offer spreads, but market practitioners noted that the market still needed more liquidity. The governor said that the RBA's holdings of bonds, which is around 36% of bonds on issue in by February, may be a factor, although the market's interest rate expectations were more likely a cause. So you can see now that the Reserve Bank is absolutely caught in a bind here. It's still maintaining its very, very low interest rate policy, despite the fact that it's basically just talking its way through now, having taken the controls away. It's also arguing for some sort of review of some of the policies, but not a fundamental review of the role of the Reserve Bank. And the markets are still signalling, and indeed the yield curve too, that rates will be rising much more quickly. And the Reserve Bank is completely underestimating, in my view, the impact of those higher interest rates on borrowers. And while sure there are some that are actually paying ahead and are fine, there are a high number of people who are very close to the edge at the moment. And unless wages growth really does pick up, and I don't think it will, we're going to see many more people stuck. Because as interest rates rise just a bit, the very large mortgages they have will demand higher repayments. Now, of course, the banks will come to the party, offering longer-term mortgages, refinancing, and I wouldn't be surprised to see some further policies from government to try and stop house prices easing back. But it does show that we've got this horrible bind where, in fact, inflation is likely to be higher than wages growth, and that the focus is going to be on people borrowing more and more and more debt. This is completely unsustainable, and unfortunately it's the culmination of 20 to 30 years of bad policy, and I don't see any change of direction yet. Maybe the election will change it. I don't think so, because I suspect both sides of politics will be on the same page. That's why we need a different way to think about the problem, as I discussed yesterday. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.